Hey everybody, this is your man Jason Myles, and welcome to Real Estate 360. Today, we're going to focus on all things multifamily. I know we've been talking a lot about creative financing, raising private capital, but all of this goes hand in hand. Why? Because there are niches in the market, and no matter where you are starting in real estate, ultimately you want to get to a point where you're getting what I like to call mailbox money. And today, we're going to be talking to a juggernaut in the space. His name is Kenneth G. Ken, right? He runs and owns and operates a company called KRI Partners, which focuses on multifamily, raising private capital and being, you know, an excellent operator. And you can't have a portfolio the size of his without being an excellent operator. We're talking about someone who has over 24 years experience in this space. He's been involved in the financial markets for a long time, private equity and such. I mean, the guy's got a resume, and he's going to share with us some of the do's and don'ts, the pros and cons, things that we're looking at in the market today. Ladies and gentlemen, without further ado, let me bring the man, the myth, Mr. Ken G, live to the stage. What's going on, Ken?
Hey,
Everybody's crowd.
Jason.
Hey!
You're killing me, man. You're killing me.
Good
Thanks so
Lord.
much for having me. I'm thrilled to be here, man.
Thank you for being here, man. And it is an honor to have someone of your caliber here to really kind of, I mean, you're for all intents and purposes, you are on top of the pile. I know there are some super massive groups out there, but with the exception of that, I mean, you're I'd say still in the 1%, right?
Yeah,
so,
we're there. We're there.
so um, it's important. Really, our listeners are of all investment levels, right? You've got people that are just starting out, and you've got people that are extremely active. You've got people like myself that, just have a relatively small portfolio. And then you have people that have, I mean, we've got people in the organization that have several thousand doors. And one thing that's a common thread, Ken, right now is, the economy. Obviously, rising interest rates affect everyone, inflation affects everyone. What are you seeing in the industry right now from a multifamily perspective?
Yeah, sure. So, we most of what we do is in Central Florida, Central Northern Florida. So the reason I like to be there is that it's a massive demand supply imbalance, much more demand than there is supply. That's really important because when we have recessions, when we have things like this that tend to slow down demand or degrade demand, our imbalance is so great that even with the diminished demand, we are still in a significant demand supply imbalance. So we're not seeing anything significant in terms of degradation of demand. That's for sure. I will tell you that we're in inflationary times right now, and so imagine we're operating with this demand supply imbalance. Now imagine here comes inflation and here comes the Fed trying to tap it down, right? They're trying to tamp it down with rising interest rates.
Mm-hmm.
So when you have rising interest rates, what happens? That makes it harder for people to buy homes. So we already have this huge imbalance. Well, the Fed is making it even more imbalanced because they're pushing even more people back into the renter pool. So it's like any economic, think about your economics class in college. Most people don't like to think about that class because it was kind of ugly, but it's what it's all about. It's demand supply imbalance, which allows us to continue to move rents, continue to improve our properties, make them nicer, and then get paid to do that. So we're not seeing any ill effects of it. In fact, especially in our markets, it continues to just go like gangbusters.
And I get that. I see how, of course, all that plays into how the economy plays into you and all other operators doing quite well in this economy. Of course, we've seen right out of the pandemic, we've seen um, apartment buildings just explode. Obviously, rents were exploding. From a rental perspective, even though we see demand going up, are you seeing in the areas that you are investing in kind of a cooling down from the rental perspective, or in terms of the actual expense that people are paying, what they're actually paying?
No, no. I mean, we're not seeing anything like that in our markets. Now, I'm pretty sure there are parts of the country that that demand supply equation looks very different, and
Hmm.
it looked very different before. So if that's the case, they're probably, they would have a different answer to the question that you just asked. But in our markets, I mean, we're not raising rents 20%. Don't get me wrong, right? We're in the value add game. So we
Yes.
go in, we know where the property is now. We're going to make it nicer. We know that once we do that, it kind of becomes a member of a different competitive set, and then we move rents accordingly. So we're getting that. When we do our underwriting, I mean, we budget 2-3% tops, rent projections above that, and we're obviously beating that without any difficulty at all. So no, we're not seeing the cooling off.
Mm, that's
We're just
amazing.
not. Now, what is cooling off is the velocity of sales, of the transactions, people buying and selling apartment buildings right now. That is definitely trended down significantly.
Yeah.
And it's because we have this buyer seller expectation gap. I have this conversation with the brokers all the time. There are sellers, they want to sell, but there are buyers who, if they tried to pay the sellers what the seller wants, well, they can't even cover their debt. So obviously that shuts the whole system down. It'll come back into balance. I personally believe rates, if you look at the forward rate curves, I mean, they're expecting rates to top out and then kind of ease off a little bit as we go into a slower economic time.
Hmm.
And, things will come back into balance. But, now more than ever, experience is so important in this business because, back when cap rates were even more compressed than they are now, you felt euphoric. You felt like, oh, rates will never change. That
Right.
I don't
Right.
need to use a terminal cap rate that's a lot higher than what I'm going in at. But experience has told us that's a dangerous game to play. And so we've always underwritten pretty conservatively. So we're doing fine. And as long as people were conservative in their underwriting and making sure that they don't get upside down with an exit cap rate, they'll be fine. I suspect there are some people. A lot of people came into this line of work pretty recently, and they may not have that experience. So I suspect, sometime during 2023, there's going to be some folks with some bridge loans coming due that, they're gonna struggle because the property is, maybe they weren't able to raise rents as much as they thought, depending
Yeah.
on the market.
And that's
So
actually a lot of the stuff we're seeing, man, on
yeah,
the lower level, or whether we're talking about single family or multifamily. And when I talk about multifamily, I'm talking about, you know 120 to 30 to 120 unit buildings, right?
yep, yep,
These folks jumped in because they could. It was a
mhm,
great idea. It's a popular thing right now, getting into multifamily and you know all the benefits of that and so on and so forth. But they, what do they say? Forgive them, for they know not what they do. you know. So,
yep,
but now they're in these situations where they've got these bridge loans, and they're not going to be able to take care of it because money has gotten so expensive. So they're gonna have to figure something out, and it's due. Like those loans are due. It's not like you
yep,
can come in with creative financing and just take it over. Those loans are
right.
due, right? And you
You
talked
are
about
right.
yeah, and you talked about the disparity between buyers and sellers, which is another thing that we see a lot of, where sellers are just unrealistic. They still think it's a year ago, and that values are still increasing, and that money is still, 2.75%. It's just not the case.
Correct.
It's so
It'll
far from.
balance out.
Yeah.
It'll balance out. We just need to be patient, right? As a buyer, you need to be patient. Let the market settle out. I mean, you look at today. The yesterday we had crazy movements in the stock market, right?
Hmm. Yep.
You can tell that the markets in general, we're talking generically, we're still the markets are trying to figure this out. So it's going to take a minute. Things will settle out, and then that gap will close. I'm very certain of that. Meanwhile, we're out raising money right now,
Yeah.
preparing, building up our war chest so that we can, we're in a good position to strike.
Absolutely, because even though you may not be acquiring right now because of that, buyer seller disconnect, sellers are going to get more realistic, and
Mhm.
buyers are just like these hungry, salivating wolves in the tree line, just waiting.
Well said. Well said, my friend. Very well said. Yes, sir.
I mean, and it is about being
Yeah.
patient. You know, you've got a lot of uh, gurus, real estate gurus, that are saying, "Hey, now's the time to buy. Now's the time to buy. Now's the time to buy." But that's not necessarily the case, depending on how you're buying. We're at the precipice of that buy season, and patience, as you mentioned, especially in the multifamily space, patience is a virtue. If you are not patient, you're moving too fast, you're going to miss something. You're going to make a bad choice.
Yeah.
And I don't have to tell you that just one mistake in your underwriting process, or just overlooking something because you're betting on the market and maybe you're a little too soon, can cost you tens of thousands, if not hundreds of thousands or millions, depending on the
Yeah.
level of what you're playing.
You're exactly right. Yeah.
And so I find
Yeah,
it.
you have to be patient. What the issue here is FOMO. People always have, you know what FOMO is? Fear
Hmm.
of missing out. And that just I have always been just shocked to see what a motivator that is for people.
Hmm.
They don't want to be left behind. And all their buddies are buying. Why are you not buying? And when we bring in a new investor, the number one discussion I have with them is centered around one word, and that's patience.
Hmm.
You're in our fund. We're going to find a deal to call your capital, but we just need you to be patient because in my world, you pay us to to do good deals,
Yes.
not to just do deals. So so FOMO really makes it hard for people to be patient. It just does.
Yeah, and that's a
But
great
you
distinction.
got to be patient. You just have to be patient.
That's a great distinction, by the way. You pay us to do good deals, not to do deals. I
That's
gotta
right.
write that. I gotta write that down.
That's so important. That's so important because it drives FOMO.
Hmm.
Right? A lot of these people that are new into business, they're trying to make a living doing this, and that's fine. That's what they're supposed to do, but they're fee driven. A lot of times they're fee driven. Sponsors are fee driven. These things matter, right? They have to collect these fees, so they tend to be more aggressive and go after deals that maybe they shouldn't.
Yeah, and I think we're gonna. I can tell you, in the secondary markets that I search in the southeast, I've watched values of properties go from. There was one 48 unit building I was looking at, and I was negotiating with the seller. The seller pulled it back out. I was looking at it at the time at 675,
Mm-hmm.
and he pulled back. The market was going up like really big time. This was at the end of 2019, and so he
Mm-hmm.
put it back on the market maybe 3 or 4 months later at twice the price, twice, and the numbers just didn't support it.
Right.
It just didn't support it. Someone did purchase it though.
Yes, they
Then a
did.
year later, I noticed it back on the market. you know,
Mm-hmm.
because it wasn't cash flowing. Someone just they
Right.
did exactly what you said not to do, and they jumped in there and they got themselves in trouble and probably lost, a few $100,000 at least.
I see it happen all the time.
Wow, and it probably happens more often than most people think.
Yeah, yeah. When you fail, you don't exactly raise your hand, tell the world, jump on TV. You don't do that,
Look what I
right?
did.
Yeah. Look what I screwed up. Yeah, no, most people don't do that, and it's terrible to watch. It really is because you really feel bad because their hearts are in the right place. They're working hard, but in this business, when you're doing what we do, it doesn't matter how hard you work; it's how smart you work.
Absolutely.
Um, you can work 80 hours a week, but if you do bad deals, you're done. You can't fix that problem.
Yeah.
So
Now for
yeah,
the
just be disciplined. That's the number one thing I want your listeners to just think about. Just be disciplined.
for the
Just
smaller operators,
hmm
those folks that are buying, I'd say 30 to 100 units. For
hmm
the smaller operators that are looking to acquire right now, what would be some of the best advice that you could give them? And I'm talking about people that have maybe been a part of an LP once and read a bunch of books and took courses by a couple guys,
Yep.
but they're
Yep.
really stepping out there on their own right now for the first time,
Mhm.
maybe even the second, but they really don't have that operator's experience quite yet. but I
Yeah.
can tell you definitively there's a ton of them out there because I'm
Oh, I
getting
know
those
there are.
calls.
I talk to them all the time.
Exactly.
Yep.
What advice or what cautions, other than the patience aspect, would you give that newer investor that's literally putting hundreds of thousands of dollars on the line
Yeah.
right
Yeah. So I didn't see this question in advance, but two things jumped to my mind because I have this conversation all the time. Number one, I want you to try to get a mentor on your team as part of that. If you're going to do this, do it with a partner, another general partner. We call it the GP pool. We don't let people in our pool, but when you're starting out, there's nothing wrong with that. You need a mentor. You need somebody that has experience that's going to help you make good decisions, and it'll actually help you raise money because people that are investing in your deals will see that you have an experienced person on your team, and that's going to be really, really important. If you don't have the experience, you can't demonstrate that you've done this before. It is much, much more difficult to raise the money. And then the second thing I want people to focus on is, and I see this one just baffles me. You've got to dive into the numbers and trust the numbers don't lie. Don't try to do high level analysis and see that through as your underwriting to close. You've got to nail down all the expenses. You can nail down just about every single number in your P&L in this business, with the exception of maintenance and repair, unit turn costs, and capital improvements, which we can estimate over the long run. But every other number you can figure out what it's going to be with some pretty good accuracy. And those numbers don't lie. Don't think that those numbers aren't telling you the truth. And so what happens is when you have that mentor, that experienced person in your GP pool, they know that. So they'll first of all stop you from doing the deal if you haven't done this level of homework, and two, make sure that your numbers make sense, and that you stay out of trouble. So those are the two things that I want to see people do when they're making that step up. Right, they're going from single family to small apartments.
now.
It is in the single family world. It's not as much about the numbers, right? Because
Right.
the cash flow doesn't usually drive the sale price. There's that disconnect, right? Because
Yep.
you get people are buying single family homes to live in them. They're not buying them necessarily for cash flow. Well, in our business, cash flow generally drives value.
Mhm.
That's the reason I like it. So if you haven't beat up those numbers, and people just some people out there are convinced that you don't need to dive into that detail, and they just don't feel like they need to do it, or they don't want to, or they don't really understand it, and it's kind of that space, you kind of this white cloud over your eyes that you don't understand it, so you don't really dive into it. But I want you to focus on the numbers, because when you do, it's going to be crystal clear that your example, that guy bought that property, that 44 unit, I think you said it was. It would have been
40.
crystal clear that he shouldn't have bought that property. It would have been really obvious.
I passed on it. I mean, it was a great
Yep.
deal at 675. Needed some renovation, some work needed to be done. There was a what I would
Mm,
consider to be at 675. I still needed to put 300,000 into it, and it
hmm
would have worked. But at 1.3, still needed
right.
to put 300,000 into it.
Yeah.
Absolutely, it was a horrible deal.
You paid the seller for all the value you're going to try to create.
Absolutely. So what I pulled out of that is three things so far: patience, underwriting, understanding the numbers, and getting
hmm
a mentor. Getting a mentor. If for no other reason than to just review what you've done, to underwrite your underwriting.
Yeah, I mean, it's just like any business. There are so many things that you don't know that you don't know. That's why you need the mentor.
Hmm.
Because they're going to know some of the things that you don't know. They're going to realize that you don't know them. I mean, it happens all the time. Oh my gosh, I never even knew that was a thing,
Yeah.
right? I hear people say that all the time. So yeah, it all kind of comes together: mentor, patience, and underwriting. And of course, my financial background, being a CPA and a commercial lender, that wouldn't shock you that I would be focused on numbers.
No,
Because
no,
why? Because that cash flow drives the value.
that's right.
That's why I
People
focus.
say numbers never lie. Numbers never lie. The numbers do tell the truth, but numbers can be skewed depending on, how they're presented, and
Oh yeah.
we see a lot of that when we're looking at people's OMs, the OMs that,
Oh
this
yeah.
company will send out. And it's always the futuristic number, right? 100% of the time. And
Yeah.
so you can't, and I say that to say, you can't trust the numbers that are being handed to you. You've really got to dig in. You've really
You,
got to dig in.
you do. And look, most brokers don't misrepresent anything. They tell you exactly what it is they're showing you.
Yeah.
They tell you, okay, I'm looking at the seller's trailing one T1 income,
Hmm.
and I've normalized the seller's expenses. And then I go from that to, I jump right over the in place numbers to year one pro forma. They've told you everything.
Hmm.
They're not pulling the wool over your eyes. They're telling you exactly what is on that piece of paper. It's just if you don't have the experience, you don't realize. Wait a minute. Wait a minute. I missed. You missed. I call it year zero.
Yeah.
Year zero matters because that's what your lender's going to look at, and you got to be
Right.
able to pay your rent in year zero or pay your mortgage on year zero numbers, not year one after you've renovated half the place.
I couldn't agree with you more on that. And people just get sucked up into it. I can give you a couple examples. We had a young man straight out of the military. He had come to us. It was a 10-unit building he was buying. He was using his VA loan. He was going to live in it. The whole thing.
Yep.
And this was the start for him. Great idea. He watched
Awesome.
some
Love it.
videos and reached out to some people. I was just one of them. I looked at the building and I told them, this isn't your deal. This isn't your deal for several reasons. One, the numbers just don't make sense. It's on the lower end, yes, but the numbers simply don't make sense. And
Hmm.
you're going to have to put in too much work for this particular property, and it's not in your numbers. Where's that money coming from? I know you weren't in the military long enough to pull that out of your pocket.
Right.
So this is a bad deal for you. It's a horrible deal. Ultimately, he didn't get it. He still tried to push forward, but he had an honest broker who just said, "Look, I can make these numbers work, but you're going to be stuck with this thing, and you're not going to be happy. It's not a good deal."
Wow, that's good for that broker
Yeah, he
because
had an honest broker.
yeah,
Honest,
that good for him.
because the kid wasn't listening to anyone else.
That's because they want to get in the game, man. I mean, think about it. You're on the sidelines. You're watching everybody do all these great things, and you're on the sidelines, and you're like, Jesus, I just want in the damn game.
But
Just give me a shot, coach.
yeah,
Give me a shot.
for sure, and it's
That's
timing. You listen to people like, and I talk about these two people a lot: Warren Buffett and Robert Kiyosaki. Warren
hmm
Buffett is a guy up until 2008 who just, I mean, even after a little bit, would just bash real estate. He hates it as an investment.
Yeah,
You
yeah, I
know,
know. He
he
said that.
just bashed it. But what did he do? Right after 2008, he bought Harry Norman, turned it into Berkshire Hathaway Brokers,
Yeah,
and went around the country buying up a bunch of real estate.
yeah.
Tens of thousands of properties he bought, right?
hmm
Obviously, you know, a great investment. Um, Robert Kiyosaki, for instance, as wealthy as he was up to 2008, he made more money between 2008 and I think 2015, 2016
Yeah,
than he had ever made prior to that. Ever.
yep, yeah,
And reading those case studies, and these are the people that are online right now telling you, don't buy anything, don't buy anything. And all they're doing is telling people to get out of the market so they can minimize competition and they can come in and buy up
yeah.
everything, you know,
It's
because
true.
you know it
True.
like I know it. I mean, it's just like the stock market. If MSNBC or any of these shows are talking about a particular industry or a couple companies, the herd mentality is let's run to
Woo.
it.
Yep.
All the while, institutional
Yeah.
investors are pulling out of it. They're minimizing because they know it's going to happen. They know it's going to happen, and
Right.
I see the same thing now in real estate and on all levels because I've been around a few of these economic cycles now, and when you're like me having this conversation with you, I'm saying to myself, okay, we've seen this, so how do we take advantage of it? You're having this conversation with me saying, we've taken advantage of it a time or two already. This is just another one. Here's how you prepare for it. I say that to say, as you're listening out there, this is a man who's got the experience of of being active and making money in and through a couple, if not a few, economic downturns. Would I be right in that assumption?
You'll be right. Yeah, I always tell people you can buy in pretty much any market. You just have to adjust your underwriting
Mm-hmm.
and then stay disciplined. You just have to. And if what's happening right now is what you see, right? This expectation gap that isn't closing, well, then you don't buy. You just don't buy. You just sit tight and wait, and it'll come back. It'll work. The market always comes back together, right? The market's going to find its way to equilibrium, and we'll get there. You just have to be patient. So what do? I always tell people I try to follow the cycles. Right? Right now is a great time to raise money, build up your war chest, so that when this gap closes, then you can go out and go do your thing and grab up as much as you can. So there's always something for you to do in this business.
Now, I want to also address another thing,
Mm-hmm.
and I'm trying to pull as much of these nuggets out of you as I possibly can. One thing you mentioned earlier was about value add. You know, we want to add value to the assets that we acquire. A lot of
Mm-hmm.
people, especially having come from the single family space, they have an idea of what it costs to do plumbing. They have an idea of what HVAC or roofing material is going to be, but
Right.
it's not the same. You're not using the same kinds of materials, and
Mm-hmm.
for different reasons, right? Of course, it depends on where you're building, but that capex and understanding the renovation aspect of it, understanding what's needed, big or small, going
Mm-hmm.
into this new acquisition of yours is vitally important. I mean, how do you add value effectively? Let's say, just to give you an example, I'm not going to go worst case scenario because I think that would be an easy one. Let's go into something where, okay, we have a property that's operating well. Maybe
Mm-hmm.
it's a mom and pop, something that, it might be 100 unit in Central Florida, which you and I know would be ridiculously expensive, at least from my perspective. But
Mm-hmm.
it's those are big deals. Like buying 100 units in middle Georgia might cost you, 3 million bucks. Take that same property and put it in Central Florida. It's
20
you
million.
start,
Yeah.
yeah,
Yep.
you're gonna start adding zeros.
Yes, you will.
We're gonna put
Yes,
another
you will.
comma in there somewhere. But you buy something like that that's performing well, but it's a mom and pop, and
Mm-hmm.
there's things they haven't done, but people are happy. It's clean, it's neat. You
Mm-hmm.
at its current rate, maybe it's operating. Maybe you buy it at a 4 or 5 cap as it currently is operating, based on the numbers you're looking at now. But because of the experience you have, you look at it and say, hey, we can do this, this, this. It's operating well, but we can add these things, or we can save money on these things over here, which is going to save us money. What kind of things are you looking at when you're acquiring something like that you're not going into and to have to, redo all the plumbing, to redo all the electric, something that operates well, but it's
Yeah.
the maybe just the smaller things that you can cut out or add to. How do you do that, and how do you calculate for that when you're doing your numbers?
Yeah, so it starts with, and actually, if you go to our YouTube channel, we on that YouTube channel is a little video I did. It's called the Jacksonville Turnaround Story. It's a property that we bought in Jacksonville.
What's
We
your
held it
YouTube channel?
KRI Partners.
Got it.
But you go there, there's a bunch of videos on there. But I talk about the Jacksonville turnaround story because what I did with that video, I get this question a lot. How do you guys add value? What do you do? What kind of things do you do? They're trying to understand what it means to be in the day-to-day business of what KRI does. So I did this video, I narrated it myself. It's not the most exciting video, but what it does, I do a lot of before and afters. I talk through why did I buy the property? What did we see? You'll see when I bought it, it was no star, right? But it was in a great area. So I talked through what did I identify up front, how did I figure out what needed to be done, and then why I wanted to do what I did. So let's now. I've taken you to that video. Watch it. It'll be I think you'll find it to be interesting. But now let's go back to how we analyze these value add deals. So I look at a property. I always start with neighborhood. You got to start with neighborhood. we just don't buy in rough neighborhoods because it's really hard to add enough value there to get people to pay more in rent. So we stick to good neighborhoods. Then we're looking for an asset that has something that is cool about it, right? I need to be able to find a way so that when somebody goes to that property, there's something that tugs at them emotionally. It's like, this place is kind of cool. It depends on the property as to what that thing is. But that Jacksonville story happened to be a very residential feel. It had a pond on the backside. It had lots and lots of green space. Okay, so that's how I thought, you know what? I can make this property a lot nicer than it is today. It just wasn't well run. We felt like it could be more than it was today. So now, I have an idea. This sounds fantastic, but is it economically feasible? That's when you have to go get out your little Excel spreadsheet and say, okay, if I'm going to do this, and that particular property, we had to do all the roofs, we painted all the exteriors, we did some improvements, we fixed up the amenity package, and we, piece by piece, I tried to estimate exactly what each one of these things cost. So in that case, we kind of backwards underwrote it. So I said, okay, if I do all of these things, I think I can get rents to a certain point. How do I know I can get those rents? Because I went out and I got on my little Google Maps and I looked at all the apartment buildings nearby, and I figured out exactly where my competitive set is now. And if I made it nicer, what would my new competitive set look like? And if a renter was looking in that price range, what would they expect? And could I provide that, and could I be competitive? So I knew where my rents could go. I knew what I wanted to do the property. I knew what the seller was asking. So now I put all this together to say, okay, if I pay this and I invest all this money based on my detailed renovation plan, and I add this much value through new rents, increased rents, is it going to provide enough value that we can make money? That's literally how we do this process. And what I do then is I may or may not like the initial result, depending. So what I then is I go back and I scrutinize my plan. Okay, do I really need to do this or that? And so I really nailed down our renovation plan so that everything we do is either dealing with deferred maintenance because we don't have a choice, or it will clearly add value to the property and make someone want to pay more to live there. And so that's how we do our value add plan. You see, our plan works because if you think about anything in business, you can't just buy a business and things just happen and you make money. It has to be very purposeful, right? So when we buy that property, we're very deliberate about every single thing we do. We are adding value because that's how you can consistently make money in business, is actually create value for the world. And when you do that, you can charge more for it, and then you can make money. So I don't know if that helps, but I think that kind of lays out our process. We do get into the weeds. I say, okay, if I need to put in, 100, that property I think was 104 units. Do I need, and we did all our work as well on the outside. So I called up my contractor buddy and said, look, I want to paint this thing. How much is it going to cost? I'm going to put new roofs on it. How much is it going to cost? The roofs were like $300,000. The paint, I think it was like 85 or 90,000, right? I put all my numbers together and figured it out, and that it's that hard work. Remember when we talked about the underwriting hard work? It's no different than with renovations. Same exact things. And then after you buy the property and you're implementing your business plan, don't be afraid to change it, because you're going to learn new things that you didn't know yesterday or before you bought it. Don't be afraid to change your plan, because that's what you should do. When you learn new things, you should, okay, does this plan still make sense? Should I tweak it a little bit? What should I do? And always be scrutinizing that.
I think
that's our business plan, my friend.
That's real. Now, I'd asked you about this before, and I wanted you to kind of touch on this as well.
Okay.
Where you had written, let me look at it. I want to get it right here. Real estate is not a passive activity. Investing is.
Yeah, that's exactly right. It makes me nuts when I hear people say, you know what, I want some passive income. I'm gonna go buy a duplex. I said, oh, you are? Okay. Who's gonna clean the toilets? Who's gonna turn the units? Well, I will. I'll do that on the weekends, man. My wife is cool. We want to build up some she'll let me do it. She doesn't mind. She doesn't want me around anyway on the weekends. I'll go over there and tinker and do my thing and whatever. And so I would ask you, well, you might be generating income, but it certainly isn't passive.
No, that's not.
That's you there swinging a hammer, using the saw. You're very, very active. So people think that real estate thing that I just described as passive, it's not. It's not even close. So the only way to be a passive investor in real estate is to invest with a firm like ours. I mean, I'm sure there's lots of other firms out there that do what we do, but when you just write me a check, I go do my thing, right? I go do all the things that I just told you about in that Jacksonville deal, and then I return a whole bunch of money to you because I did a good job. That's passive investing. What did you do? All you had to do was write the check. You still went to your day job. You still did whatever it is you did with your family on the weekend. Mm-hmm. You had no commitment. So I always like to get people to kind of really make sure that they focus on what is passive versus active. They just think that they're going to buy this duplex and, that's going to be mailbox money, but it's not going to be mailbox money. It just never is when you stay that small.
Even with a good property manager, you're still involved. And
well, it's hard to afford a good property manager with smaller properties.
Absolutely.
I mean, it just is. How much time and effort? I always say, I used to have people come to me, hey, can you look at my, my property management company's not doing a very good job. My occupancy is whatever. People aren't paying their rent. And the first thing I ask them is, well, how much are you paying your property management company? Well, I'm paying them $500 a month. I don't know. I'm making up a number here. And so I ask them, how much time and energy and resources do you think they can commit to your property for that whopping $500?
That's right.
Not very much. So you're getting what you pay for. That's exactly kind of the way it is. In our world, 250 units, the management fee is $10,000 a month. Guess what? They're going to put some time and attention on that. Now we happen to manage our own properties because we're pretty focused on how we do things. But now we have the ability to throw the right resources at it when the management fee is high enough that you can do this profitably. Does that make sense?
Absolutely. It brings up another great point because you'll hear some people, again, I'm not going to say any names, but they'll say, don't put your own property management in place until you get to this place, or start it right away. Start it right away. Learn your processes, implement your own. I think starting your own management right away, if you do not have operators experience or enough operators experience around you and the time to be hands-on, putting your own management in place in the beginning is a horrible idea. That's my position.
Yeah, it's tough. It is tough. That's how we've always done it. I tried a third-party manager for about 30 days. I got rid of them after 30 days.
Right.
But it's I had always once I figured out how lucrative this business could be, and I saw how some third-party management companies are not the best. My company originally grew up in Cleveland, Ohio. Mm-hmm. That's where we made money for our first 10 years of our existence. Mm-hmm. And there's no third-party management infrastructure in Cleveland because nobody invests in Cleveland from outside of Cleveland. So it's a total owner-operator town. So I kind of grew up that way.
Okay.
Because I could, there were a couple of third-party managers, but like I said, the only one I hired the last 30 days, and I said, this isn't working for me. So we moved on. Now in Florida, there's third-party managers on every door, on every corner. They're everywhere because so many people invest in Florida from outside. But we just simply continued to do what we do. Now, here's the thing: you have to be prepared that in the day of a life of Ken Gee, I spend more time than I wish I had to on some management activities. Now we've gone to the point where I have got some really top-notch people in our senior management team. I spend very, very little time on management. It's usually just checking in, answering a few questions, things like that. But there was a time when, I was trying to figure out how to get the units turned and so on. So, over the last 25 years, I've developed systems and processes, and now it's a pretty well-oiled machine. But you're right. You have to ask yourself early on, what do you want to commit yourself to? Do you want to commit yourself to finding deals and underwriting, or do you want to commit yourself to trying to figure out how to evict this guy or gal who won't pay their rent, and
Right.
what should you do, and all that kind of stuff. It's a good, it's a decision that you have to make. It
It's
was
an
kind of made.
opportunity cost.
It is, yeah, it is. Yep.
And where you value your position in your
Mm.
organization. Where do you have the most value? Where do you give the most value? And if you're,
Now,
I'm sorry, go ahead.
I will tell you that I think, I didn't mean to interrupt, but I will tell you that I think we are more successful because we manage our own stuff, because we're vertically integrated,
Hmm.
because we've just learned so much along the way that it's hard to find third-party management companies that have been doing it for 25 years, who have been that focused on really fine-tuning their operations, and it gives us that visibility all the way to the ground. So that, remember, I talked about pivoting on your renovation plan and
Hmm.
things like that.
Yep.
If you've got somebody else below you, you might not have access to the information that you're like, oh man, I wish I would have known that,
Mm.
because I would have changed my plan. So we have a better chance at that. So it has served us very, very well. There are days that I wake up that I wish I wasn't the property management firm, but I think our investors have benefited enormously because of that.
Well, I would imagine, even though you're employing folks, you're saving money as opposed to paying 5 or 6% to an outside management team.
Well, I mean, we pay ourselves, right?
Oh,
We
right,
pay
right.
ourselves
Of course.
a fair wage
Yeah.
to do it. Where we save is our expertise.
Hmm.
We've been doing it so many times. When we go into a property to turn it around, I'll just give you an example. We have, it's called our 90-day turnaround plan. The first 30 days is like triage. Remember the MASH movie?
Hmm.
Where where the helicopters would show up, and then the nurses and all Al and Aldo would be there, and they'd all do triage, right? That's the first 30 days when you own the property. Then the second 30 days, we start to impose our will on the people. They understand that they actually have to pay rent, and we start to figure out who the bad guys are, and we start to move against them. And then by that third 30-day period, it's kind of our property now. It feels like our property. People appreciate the level of service they get. So here's what I'm trying to illustrate. I'm trying to illustrate that we know it's a 90-day turnaround plan. We know exactly what's going to happen in each phase. And so we can be really consistent and efficient about how we turn properties around, rather than risking that we hook up with a property management company who doesn't really have that much experience with turnarounds, right? You just got to be really careful. So I just wanted to point that out, but as a way that I think we've added tremendous value. And it's not uncommon for, if you think about a typical private equity firm that's not in real estate, say they go buy companies, they pride themselves, most of them do, on their ability to bring their expertise down to the company that they've acquired and adding value through that process. And we kind of do that same thing when we buy properties. Does that make sense?
Absolutely, 1,000%. You know, it's a business that, for me, it's a business or an aspect of the business that is consistently evolving, but there are processes that are continuous through that evolution. Does that make sense?
It does. Yep. Yep.
And there, in fine tuning those things, as you've just described in your business, is where you really, because moving with ease is more important than making all the money.
Right.
You
Mm-hmm.
know, understand, and not meaning you're giving up money. It's just a better place to be. And I like the fact of how you broke it down, where you have all the information. So if you need to move laterally, you can do that.
Mm-hmm.
I think that's extremely important in dealing with this. So my next question to you is this.
Mm-hmm.
For the accredited investor that's listening right now, for the non-accredited investor that's listening right now, and they're saying, listen, I want to look at some of these deals they're doing. I'm interested in having a conversation with Ken or Ken's team about getting involved in some of these projects and what that might look like for me. How do they do that?
Yeah. So our website, actually, I have a book that I want them to read. It's a free giveaway. KRIPartners.com/ebook. The book is titled Multifamily Real Estate's a Total Game Changer. And it talks about two things. Number one, very much what we've talked about here, right? There's a ton of money to be made in real estate. You're just trying to figure out how it's going to fit into your life. So I help take you through that process, look at the different types of assets that you can buy and how you can get involved. Now, most people should be passive investors. So that brings me to the second part of the book, and that is, if you should be a passive investor, how do you vet sponsors and how do you figure out where to put your money? That's what I devote the second half of the book to. So kripartners.com/ebook, and then just reach out to us. You can call us directly if you want to actually have a conversation with us. We call them an investment call. We're going to talk about what's going on with you. What are you trying to achieve? We'll talk about what we do, how we do it, and see if there's a match between what you're trying to accomplish and what we're able to provide. So most people just call 813-489-9666, 813-489-9666, and that rings right to our office. And one of our investor relations people will talk to you. Their goal is to try to figure out if you might be a good fit. And I do want to have a conversation with you because I just want to make sure that you're right and you've had the ability to get all your questions answered. So I take a lot of pride in the fact that I try to talk to every one of our investors before they come on board. But if you can take a look at that book, it'll really help you understand, so that when we do talk, you'll be a little more more educated about how our business works, and it'll help you ask better questions and make sure that we're the right fit for you.
That's excellent. That's great that you have that resource as well. And now, will that be I'm assuming that'll be a digital download?
It is, yeah.
Yeah. Just wanted to clarify. I know you said ebook.
Yep.
I just wanted to
Yep,
clarify
it
for
is.
folks so they're not
And it's free
by the mailbox.
Yeah, it's free. No, it's free. It's free.
Yeah, so that's fantastic. I'm actually gonna sign up and get a copy for myself. I want to check it out. But I wanted to also reference back to your YouTube clip. It's called the Jacksonville Flip.
The Jacksonville turnaround story. Yeah. So our YouTube channel is, now look, I'm not a super cool YouTuber, all right? I just want to set the expectations right here. But there's some really valuable information that we've put into that channel, and it's KRI Partners is the name of the channel, and we try to put out content at least once a week. And it's deep. We do a lot of deep dive stuff, right? How to maintain occupancy. We do a lot of the stuff that's really important. That it's my goal that if you spend some time on our channel, that I hopefully can add some value and bring some information to you that you didn't have before. But that Jacksonville turnaround story, that is just an awesome example of how to add value to a property. I mean, the before and after pictures they're amazing. I mean, it's ridiculous. And when you see the video, you'll know exactly what I mean. It's about 20 minutes long.
And that it's just, I mean, I don't want to, I want to be respectful of everyone's time here, but I'm telling you guys, that's the kind of stuff that you really, really want to focus on. You want to learn about, you want to understand, because it isn't just it's not like just flipping a house, right? I mean, you could really lose your shirt by not doing this correctly. I know people that have, they want to do all these, fix and flips on apartment buildings. And in theory, it's great. It's perfect. It makes sense. But if you don't know what you're doing, and the skill set doesn't necessarily for everyone transfer from single family to multifamily overnight. You do need to have a mentor. You do need to have some education. You've got the skills, you've got the desire, you've got the ability, but you have to be specific to that particular industry. So repositioning a multifamily property can cost you a lot of money because of the time that you didn't think that it was going to take. I mean, you could lose, and people do lose regularly on these things. It's not just about being, cash rich. It's going to be a money pit if you're looking at it like that. You've got to do your work. So um, I'll definitely share this video as well. I'll put links to all
Awesome.
these things in the description, you guys. If you're listening, they're there. They're underneath in the description. All you have to do is just scroll down, click the link to the Jacksonville turnaround, the link to the book, the link to the channel, as well as the link to the website. All of that will be there. You'll be able to reach out and talk to Ken at any at any moment that you're ready. Excuse me, because if you're going to be a passive investor, like you said, most people should be passive investors. If you're going to be a passive investor, do it with people that are operating on a high level, right? Just do it that way, because you don't know who you can trust. There are some people out there that are very vocal, that are very visible, that might not be the right fit for you. So look into it, as Ken says. Do you have anything to say in closing, Ken?
You know what? No, it's been a pleasure being here. I hope I've shared some good information. And, I could go on for hours and hours and hours. I'm certainly not going to do that. But, if you go to our YouTube channel, you'll get, this, you'll hopefully learn a lot. So look forward to talking to some of your listeners one-on-one. I'd really enjoy that.
Absolutely. And guys, again, as always, wherever you are right now, do what you got to do. Get the information, get the education for where you want to go next. Start to build yourself up before you get there. Be known before you need it. You know what it is. This is your man, Myles. Thank you for your time. Thank you for listening. Thank you for watching. We'll see you guys next week.